A lot of people think that the Fed has been successful in reducing inflation because, it went from 9 down to 3. And so maybe an extra quarter point or maybe a half point will complete the journey, right? Because we're almost there, but we're actually miles away, because the main reason that you saw that big drop from 9 to 3 was a collapse of oil prices and other commodity prices that was basically brought about by a surge in the dollar, where currency traders were starting to price in all the rate hikes. So the Fed actually already got all the bang for the rate hike buck from that move. Now, oil prices are headed back up. We're back above $81 a barrel today, headed higher. Other commodity prices as well. The dollar has peaked, I think, and is declining. So the headline CPI probably has bottomed out in the low 3s, and now it's headed back up. Meanwhile, if you look at the core, which is what the Fed claims is more important anyway, that's still around 5. And the decline in the core is far less than the decline in headline. I mean, it's barely gone down, despite the fact that we've moved interest rates from 0 to 5.5. So if the terminal rate is 5 3/4, 6, that's not much from where we are now. And so why would that actually do anything when we haven't seen a meaningful decline? And also, people forget that these rate hikes are in and of themselves price hikes, because it's the price of credit, the price of borrowing. And so every business that has debt is now having to pay more to service that debt. Whether it's your landlord who's got a mortgage, a commercial mortgage that's resetting, or it's a business that has borrowed money to purchase plant or equipment and has interest rates to pay. That's just like labor costs or raw material costs. It's another cost of doing business that is rising. And so businesses then try to pass on those higher costs to their end consumer with higher prices. So as higher interest rates continue to work their way through the cost structure, you've got more upward pressure. So I don't see how the Fed has really accomplished much of anything. And also, if you think about the way rate hikes are supposed to reduce inflation, and Powell will admit this when he talks, they're supposed to reduce aggregate demand by making it more expensive to borrow, so that people will borrow less and they'll spend less, and that'll, slow the economy, the way they describe it. But none of that is happening. Credit card debt is at an all-time record high. The government budget deficits are skyrocketing. We're on a run rate now of north of $2 trillion a year in deficit spending, and we're not even technically in a recession yet. I mean, normally when you're in a recession, the deficits double or triple. And so, but they're already enormous. And so even though the Fed has been making credit more expensive, it hasn't slowed down demand for borrowing. Consumers just are paying the higher prices, borrowing the money anyway, and spending it. So all that spending is still driving prices higher. So I don't think the Fed has made any headway at all. The way they've doctored the numbers is they've doctored the CPI itself. So they would have to make changes again to the methodology of computing the CPI, which I think they may have already done that to a degree, and they may do that some more. But that's why the whole thing is ridiculous, because when they say 2%, they actually mean 4%, because if we measured prices today the way we did it in the 1970s, 2% would be 4%. And in fact, all the years where the Fed claimed we didn't have enough inflation, which was all BS to begin with, because it was below its 2% target and we needed more inflation, we were never really below that target. We were above it the whole time. It's just that they were measuring it improperly. And the reason they did that was because they wanted to justify printing all this money to stimulate, the economy and to finance deficit spending and, to take the politicians off the hook from having to make the difficult political choices that may have jeopardized their reelection, because absent the Fed printing all this money and keeping interest rates artificially low, politicians would have had to have cut spending. And so that means that they risk losing the votes of the people who were losing their money. And so nobody had to do this because we were able to create all this inflation. But now the inflation chickens have come home to roost. And, this is a huge, huge problem it's insolvable and is going to get worse. First of all, he had to pay lip service to the idea that the Fed is going to get inflation back down to 2% and do whatever it takes, right? Come hell or high water, we're going to do this. Powell did admit that we're a long way from there, which is my point. I mean, if we're a long way from 2% and the Fed is already at 5.5%, how are we going to finish this journey if the destination is so far into the distance? But I thought that the most disingenuous aspect of his talk is that he's talking to the nation about the inflation problem and how great a threat it is and how it's so important to the Fed, to extinguish this threat, but no mention of the massive fiscal stimulus that is being pursued by the White House and Congress, because you're trying to put out a fire and Congress is pouring gasoline on the very fire you're trying to put out. You're not making any headway. What Powell should be doing is what Paul Volcker did. When Volcker was in his position and he was trying to fight inflation at a time where the governments were running large deficits. Of course, they weren't large, by today's standards, but they were large by the standards of the day. And Paul Volcker was, harshly critical of the deficits and was scolding Congress, saying, you got to cut spending because if you want less inflation, we need less government spending. We need to, reduce the deficit, balance the budget. But Powell completely lets Biden off the hook in Congress. He acts as if these deficits don't even exist. He's saying we're trying to reduce aggregate demand with higher interest rates. Well, the government is stimulating aggregate demand with massive budget deficits. So which is it? I mean, how are we going to have stimulative fiscal policy and contractionary monetary policy? They're working at cross purposes. How are we going to make any headway? We're not. And ultimately, what's going to happen, if the deficit spending continues, which it will, the Fed is going to have to choose between a massive increase in long-term interest rates, far beyond what we've already seen. I mean, we're at, 18-year highs or something like that, 16-year highs. The yields on the 10-year, out to 30 years are, 4.2-ish. But if these deficits continue, and the Fed continues with quantitative tightening, these yields are going to move up to 6%, 8%. I mean, they're going to go substantially higher. And of course, that's going to have a profound effect on the financial sector, on real estate. I mean, the whole economy is ultimately going to collapse when we get a return to those type of rates. In fact, everybody believes that we're going to go back to the really low rates that we had for more than a decade. That's never going to happen. And so maybe an extra quarter point or maybe a half point will complete the journey, right? Because we're almost there, but we're actually miles away